I'll stand up for just a second so you can see me. I'm 4 weeks post-op knee replacement, so I'm supposed to be sitting down with my leg propped up. So here I am, but I'm about to sit down. You'll have to look at the slides. I'll also mention I got about an hour and a half, 2 hours worth of presentation material. One of the things I've done, I only have 25 minutes and we're already into that, but one of the things I've done is basically summarize the new tax law that they just passed back in November, December. And I've left a copy of this with Billy. If you would like a copy of the slides, there'll be a lot of things that I don't get to talk about. They will be on the presentation and they can provide you a copy of that. Right, so let me just mention real quick, there's not very much in the actual area of timber tax that's new. The only thing that they added, and it's been a couple years ago, was this 1099 reporting. So if you were on a pay-as-you-cut, you got a 1099 if you were a landowner, but if you had a lump sum sale, there was no requirement that you have a 1099. So the IRS felt like they might be losing a little bit of tax revenue, and so the regulation was changed. So now whether you sell timber on a lump sum basis or on a pay-as-you-cut, you should be getting a 1099-S. Next slide. And I just put the reporting person up here. The only thing I wanted to mention on this, you'll notice that the person that's closing the sale is the one that's supposed to report the 1099-S. But if we get down to it and nobody else has reported it, you will notice that you, as the last choice there, have to tell on yourself and send in a 1099 to the IRS. Don't forget to send your tax money in as well. I just wanted to mention because there aren't many new issues in timber tax, I'm not going to talk about that. What I really want to talk about is how we're going to raise some tax money, and I'm going to talk about some estate planning because those are kind of new hot issues and there's a lot of uncertainty on that. I did want to mention that I will be doing a series of timber tax workshops, and those workshops we actually talk about timber tax in general, and then we specifically say, okay, here is the form where you put that particular information that relates to it. So the workshop is like a 6-hour workshop. We explain timber tax, and we also talk about how you file with the IRS. Every form that you need to use, we give you examples and everything. And Billy says he'll put those in the calendar. One of the things I'm interested in is if you would like one of these in your area, if you would let me know. We'll probably do 3 of them, one kind of in the northern part of the state, one in the middle, one in the south. We did that last year also. So if you happen to have an interest in it, having one in your hometown, let me know. One of the big uncertainties right now, we've been running deficits in the budget since the Bush years. One of the issues, of course, is we're talking about cutting spending. But even if you cut spending, we're still going to have a deficit, so that means there's got to be some new income. And everybody's been talking about, well, we need to tax the rich. If you happen to be in that category, I'm sure you're voting no. I'm not in that category, so I don't really care. So, but anyway, there are 9 areas right here that they are looking at in terms of raising revenue, and what they are basically are deductions that ordinary folks normally get. And so as they start looking at where are we going to, or how are we going to balance the budget, cutting is not going to do it. We've got to raise revenue. If we don't raise revenue by taxing the rich, then we've got 8 or 9 options here. So Don't want to spend a whole lot of time on these because I was going to talk about something else, but you can see some of these are very popular. Most of you probably enjoy some of these, and they save thousands of dollars. So employer-provided health insurance, almost everybody now takes that, or it's not counted as income. So they're planning on adding that back as income. The mortgage insurance deduction or mortgage interest deduction you get right now, that's one of the things they're looking at. Tax breaks for retirement plans. In other words, we wait and get tax money much later than you actually earn it. So there's a very long lag time. So they're looking at potentially getting rid of some of that. Anyway, if you got a question on any of those, I'd be glad to talk about them, but it's just kind of a laundry list of where Congress is looking at potentially raising money. Okay, so let's talk about recent tax legislation a little bit. That first one there, the Economic Growth Tax Relief Reconciliation Act of 2001, kind of old news, except it got extended for 2 years. And remember, that's the one that eliminated the estate tax for 2010, raised the applicable exclusion amount over a series of years, and actually dropped the tax rate. So I'm not going to mention the ones in the middle, but then that last one, the Tax Relief, Unemployment Insurance Reauthorization, and Job Creation Act, is what we're under right now. Okay, and so what happened then is it extended the estate tax relief for 2 more years. So for the next 2 years, not only did it extend the tax relief, but the applicable exclusion amount has been increased to $5 million. So if you, hopefully all of you have plenty of land and you're worth more than $5 million. If you are, I'd love to talk to you after the class, but anyway. So right now we are at an applicable exclusion amount of $5 million and 35% tax. If you happen to have had a relative who died in 2010, if you have not finished the estate yet, you have the option of either using the no estate tax, which is what was part of ECTRA, but remember you did not get a step up in basis, the fair market value date of death. So what they did basically was make the law retroactive into 2010. And so if you did have someone that died that had less than $5 million worth of property, you have the election to go ahead and use the $5 million rate that was available in 2011, but they retroactively made it an option in 2010. But then you could actually get the step up in basis to fair market value that you couldn't get if you elected not to pay any estate tax. So if you have an estate that's less than $5 million from last year, you really shouldn't be using the no estate tax option because you're limited on how much basis you can claim in the assets. So you really ought to be using the newer option where you could exclude $5 million but get a step up in basis. Okay, next slide. Okay, just to give you some numbers on how many people are actually affected. So with the $5 million in 2011, they only expect 3,600 estates to be affected by the estate tax. So that is 0.14%. If they'd left it at $3.5 million, it goes up to 6,160 estates, which is only 0.24%. And they estimate that if it had gone back to $1 million, then 46,000 or 1.76% of the estates would be affected. Okay? And where we are right now, of course, is that the rate is $5 million for 2011 and 2012, but in 2013 it is going back to $1 million unless Congress does something. And so one of the issues is the exclusion amount is $5 million right now. It is going back to $1 million unless Congress does something. Now, Congress is probably going to do something. It probably won't go back to $1 million. But you have to remember, Congress actually has to do something. So if Congress can't agree, all of those Bush tax cuts expire in 2 years, and that's what the rest of the presentation's about that I won't get to talk to, but it's on the slides. But the estate exempt or the applicable exclusion amount will go back to $1 million. Okay, and if we have gridlock like we've had for last several years, they may not be able to agree on anything. So right now the issue is, what should you be doing? So if you have an estate that's worth more than $1 million, you really ought to be thinking about transferring some of those assets right now. So if you've got more than $1 million, hopefully you could live fairly comfortably on $1 million. You need to start thinking about transferring those assets to the next generation, because if the tax rate stays at 35%, which is not very likely, that means that for every dollar over $1 million you've got, Congress will be taking back 35 cents. And actually, if it goes back to $1 million, the tax rate's 55% with a 5% surcharge. So if you're worth more than $10 million, the rate's actually 60%. Okay, and so one of the things you need to be thinking about is, if you are worth more than $1 million, you need to be thinking about transferring assets to the next generation. And there are several ways you can do that and still hang on to it. One of the big issues, though, is should you actually make use of that $5 million exclusion amount right now? Quick history lesson. Under EGTRA, remember we started off at $1 million, it went to $1.5 million, then $2 million, then $3.5 million. The gift tax applicable exclusion amount stayed at $1 million because in 2011, when it expired, we were supposed to go back to $1 million as all you could give away. And so if you happen to die in one of those years, you got the increased applicable exclusion amount. But if you were still alive in 2011, you would have only been able to pass $1 million. So that was all you could do during life. So now that they've raised it to $5 million, and if they don't do something, we're going back to $1 million in 2013. There's something called the clawback. So let's say you gave away $3 million, and we get to 2011 and it goes back to $1 million. That means you gave away $2 million more than the current law says. And there is a good chance that you will end up having to pay estate tax in 2013 on that extra amount if it goes back to $1 million. I've been to a couple of workshops. There was an attorney that was up in the Virginia area. He talked to some of the people that did the writing on the tax law, and they basically said, we forgot about that. And so they didn't address it. And so they said, oh, we'll take care of it so it doesn't cause an issue. And I got a bridge I'd like to sell you. So the issue then is, if you've got more than $1 million, you need to be thinking about transferring assets to the next generation to save taxes. But before you get just hog wild happy and start thinking about giving more than $1 million, you need to think about whether that is going to be an issue or not. So let me just, real quick, estate planning note. Why should you give money during life as opposed to waiting until you die? Okay, and so first of all, there are two major reasons, one reason why you shouldn't. Okay, but first of all, the effective gift tax rate is lower than the estate tax rate. Okay, and so right now with 35%, if you had $1 million that was taxable, the government would take $350,000 and you would leave your beneficiaries $650,000. And it's because the way they calculate the estate tax, they look at the total value of the estate, they apply the percentage. A gift tax, the rate's still 35%, but the tax is actually based on what the beneficiary receives. In other words, if you had $1 million to make a gift and pay the tax, you could give the beneficiary $740,000 and you would only pay $259,000 in tax. If we go back to 45%, then of course the difference is even more significant. Okay, so it's not that the tax rate is different, it's the tax base is different. So with an estate tax, we look at the total value of the estate. With a gift tax, we look at what the beneficiary actually receives. So it is cheaper tax-wise to gift during life. The other reason that you gift during life is that you remove income and appreciation from the estate. So you've got a piece of land worth $1 million right now, and in 10 years it'll be worth $2 million. So if you gave the $1 million worth away now, then the extra $1 million in appreciation would be out of your estate with no tax paid on it. While you're thinking about gifting, though, the thing you have to remember is there's always a basis issue. So with a gift, the donor takes the donee's basis. So if you got $1 million worth of land that you only paid $100,000 for, then the donee's basis in that land is also $100,000. And so what you're doing is giving them a potential capital gains tax liability. On the other hand, if you give something from your estate, they will get a step up in basis to fair market value date of death, and so you don't have that built-in capital gains. Now, if we're talking about property that's been in the family for 3 generations and you expect your children to hang on to it, you don't really care what the basis is. So that's something you need to think about. Okay, so if you were going to start a gifting program, the first thing you do is make what we call tax-free gifts. And so you can pay tuition and medical expenses for your children, grandchildren, whoever, and it does not count against your applicable exclusion amount or your annual exclusion. So these are just straight out tax-free. So pay your grandchild's long-term care insurance, health insurance, pay medical expenses. The one caveat on this, they have to be paid to the provider, not to the individual. So you can't give your grandchild $10,000 to pay tuition, you have to pay it to the university. So you pay the $10,000 to the university, you just reduce the value of your estate by $10,000, had absolutely no tax consequences on that, and of course it helped your children, and so you've taken that out of the estate. The next thing you need in a gifting program is your annual exclusion gifts. So this happens to be Code Section 2503B if you happen to be interested. But you can give $13,000 per donee per year. and husband and wife then can give $26,000. So if you have children, grandchildren, you're trying to reduce the value of your estate, you ought to think about how you use your annual exclusion gifts. You can actually add in grandchildren, spouses, and get quite a large amount of money out of your estate using annual exclusion gifts. Okay? And I'm going to talk about whether you gift it outright or not here in just a second. Okay? Then the next thing that you think about, remember you can comfortably give $1 million during life. So the first thing I'm going to tell you is I don't advise you to just gift $1 million worth of asset. There are ways to stretch that $1 million. Okay, so if we're talking about, we've done our tax-free, we've done our annual exclusion gifts. The next thing you think about is how can you use the $1 million that you can transfer during life without paying any tax? First thing you need to get rid of is your life insurance. And when I say get rid of, I don't mean terminate it, I mean change the ownership. Don't have time to get into what's actually in your taxable estate. Everybody thinks life insurance is tax-free. It is income tax-free. It is not estate tax-free. So if you've got a $500,000 term policy that pays your children, that $500,000 is included in your taxable estate for estate tax purposes. So you are not benefiting on your life insurance, somebody else is, so somebody else ought to be owning that life insurance, so you remove it from your taxable estate. Okay, one of the most common ways of removing it is to put it into an irrevocable life insurance trust. And again, I'm short on time, so I won't get too much into that. How many minutes do I have? Okay. Oh, 5 minutes. Okay. So I got 32 slides. We're on number whatever. Not very many. So the first thing you do is think about getting rid of your life insurance. Then there are what we call split interest gifts and discounted gifts. So you can give away $1 million. But what we do, a split interest gift is where you put something in a trust, you retain an interest in that trust for a number of years. One of the common techniques is called a QPERT, Qualified Personal Residence Trust. You put your house in it, you live in the house for the next 15 years, and then the house goes to your children. Well, because your children don't get an interest in that house for 15 years, we discount that value back. And so maybe you got a $250,000 house. You can actually get it out of your estate for only using about $175,000 of your applicable exclusion amount. Okay, so with a split interest gift, you can actually transfer more. The other thing that you need to think about doing is forming a business entity. Business entities are wonderful estate planning tools. In Alabama, the LLC has by far got the most benefit. Basically, you can set up a business entity where mom and dad can be managers of the business entity. They maintain 100% control no matter how much interest they own. So mom and dad can own 10%, the children can own 90%, but mom and dad have 100% control over the business entity. And again, that's a whole other area, and I don't have time to get into that. So what's the next slide? I'll go past that one too. Let me just mention this real quick. The basis rules, of course, when we're talking about basis, you got fair market value on an asset, you sell it, you've got some investment in that. That is your basis. The difference between the fair market value and the basis is your income. That's what you pay tax on. Okay, one of the things that EGTRA did was delete Section 1014 or repeal it, which means the step up in basis went away. Now that has been reinstated with this new act and should continue. One of the neat things that's in the new bill that probably will stay in there if they change it is portability. So right now your applicable exclusion amount's $5 million. That means husband's got $5 million, wife's got $5 million, so $10 million total. But in the past, to actually utilize that, each spouse had to own assets. And so if the wife died first, but the wife only had $1 million in assets, then you could protect that $1 million. The other $4 million you could have protected is gone. You just lost it because the wife didn't have enough assets to cover the applicable exclusion amount. So what they've done now for the next 2 years is institute this thing called portability, so that, or let me back up. So the way you used to do it, you would have a credit shelter trust and marital deduction trust, and then you basically had to transfer assets between the husband and wife to make sure you had the funding for the credit shelter trust. Now you don't have to worry about doing that because of this portability, but it's only available for the next 2 years. And I guess this is probably about the last slide I'm going to be able to talk about. This is the start of the income tax impacts of the new law that they just passed in 2010. So these are the things that are automatically going away at the end of 2012 unless Congress does something. So right now we have that 10% tax rate. That was one of the gifts of the Bush tax cuts. So the 10% tax rate will go away unless it gets extended. The marriage penalty, of course, will be reinstituted. You'll notice that for the first couple of tax brackets, the married rate is twice what the single rate is. That will not be the case after the tax law changes. The one thing to think about, if you happen to have an IRA or any other kind of tax-deferred fund, for the next 2 years, the tax rates are probably as low as they are going to be. So if you are taking money out of an IRA, you may want to take a little extra the next couple of years because the tax rates are never going to be less than they are right. Well, I can't say never, but I'm betting that the tax rates are never going to be lower than they are right now. And there are another whole bunch of slides on other income tax impacts. So if you want to contact AFOA, they will be glad to send you a copy of all the rest of it. And I'm sorry, but that's all the time I have, unless somebody's got one burning question they need to ask. Okay, so there was a question about the Roth. So everybody understands that a traditional IRA, and one of the problems with the traditional IRA is everything that comes out of it is ordinary income. And by the way, that's another thing that potentially going to go away, is the fact that dividends are now taxed as at the 15% rate. That could very well go away. So the problem was you had a lot of traditional IRAs that were investing in stock, and the money would normally have only been taxed at 15%, but by law, everything in the IRA gets taxed at ordinary tax rates. And so IRAs all of a sudden don't look like such a great deal. And so a Roth IRA, you put after-tax dollars in. You can also roll your regular IRA over to a Roth IRA. The problem is you have to pay the tax on that now. And so again, tax rates right now are probably as low as they're going to be. So If you are thinking about rolling a Roth or a traditional IRA over into a Roth IRA, actually last year was the better time to do it, because you could spread the tax over 2 years, but you still can roll your Roth IRA or roll your traditional IRA over into a Roth. You will have to pay the income tax on it, but again, the rates are probably lower now.